Start. So I guess, the biggest theme, whether it's alternative media or mainstream media lately, and I would say lately the past like week, maybe 3-4 days, is Fed rate cuts. Because as you know, at the last FOMC meeting, the Fed came out and projected 3 rate cuts next year, even though the market said, you know what, 3, we're going to head and price in 6 or expect 6, which is insane. And I don't think that's going to happen. But anyway, and so that's been one of the bigger themes. And so I guess I would start by what would be the 2 reasons that the Federal Reserve cuts rates? Well, the first one, you probably heard it already, and it's the most simple in that, well, obviously something breaks, and that's their response. And so you could infer from the fact that they forecasted 3 rate cuts that they're projecting something to break, which would force them to cut rates and start easing to bring things back into a balance.
The Fed is projecting 3 rate cuts?
Yes.
By when, do you know, or just throughout the whole year?
Basically through the whole year, but to start in about March.
Okay.
Yeah.
Do you have any idea as to what could break first, or what they're thinking is going to break first, or no?
So in my opinion, it could be the labor market. The labor market has been eerily stagnant. The unemployment rate remains unchanged, even though they expected it to go up. And so it's been like eerily stagnant. So it has to move in one direction. It's not just going to stand still. And that's effectively what it's been doing, because there's a good balance between supply and demand, aka job openings and potential labor. And so that balance still exists. But if anything, I think it could be the labor market. And the other reason why they will cut rates is to simply bring real rates down from a more restrictive level, which we are now. If inflation actually is sustained at around 3%, let's just say 3% for easy numbers. If it stays around 3% and we're sitting at 5.25% on the Fed funds rate, we're at 2.25% in terms of the real rate, which is actually really restrictive. And so because inflation has come down, if they're expecting inflation to stay where it is, which I actually don't know at this point, so I don't have an opinion on the direction of inflation here in the short term. But if the Federal Reserve is expecting inflation to stay sustained at around 3%, well, that will warrant 3 rate cuts, which would bring us to around 3 rate cuts from 425, basically 375, basically. That's where that will put us. And so that would be actually really loose. So that would be less than 1% on the real rate. And so that would be the other reason they lower rates. So for those 2 reasons, I can see now, because I believe the recession was due. I was one of those guys who was hard in a recession, and obviously I've been super wrong on that. But at this point, my initial thought when he came out and made the comment about the 3 rate cuts is that, okay, we're definitely getting a recession. But then, I thought about the inflation in the real rate on the Fed funds rate. So I'm like, okay, that makes sense. So we may actually be able to avoid a recession, which would shoot the stock market to another level, because we avoid a recession, obviously.
That'd be crazy.
Yeah, that would be insane. And I also remember making an argument about bond yields and how, they could potentially move higher unless demand came in hard enough to where it pushed yields back down to, just a lower point. And I think I was actually wrong on that as well, but it still has time to play out. And if they were to cut rates, or let's say if we cut rates just because of inflation and we avoid a recession, well, that would actually put downward pressure on bond prices, which obviously means bond yields will move higher again. And now you have that competition that starts to brew between stocks and bonds, which if you're generating 5% on bonds, even in a good time, certain investors who have billions of dollars in pension funds and all these money market funds, that's their primary buy right there. They're going to buy it no matter what, but they're going to eat it up at 5% yields, because now they lock in a yield and they're going to have appreciation when it comes to maturity. And so in the end of that, I can see just that pushing us into some type of financial asset recession, just because the action that we'll see in bond yields moving forward potentially. And so we're still at a point where we could paint multiple scenarios. It's just the only difference now is not 4, it's just 2, pretty much. And so that's like a synopsis on it.
What do you see housing doing this year?
Housing's just going to keep going up, to keep it simple. I've been saying the same thing for the longest. It's really a supply problem. That's literally the issue in housing. No matter what type of data we see, even in November, prices went up 4.8% according to Case-Shiller, which is obviously our most notable housing aggregator when it comes to prices. So the Case-Shiller index rose 4.8% year over year. So prices are still going up pretty heavily, even though in the later half of 2023, we saw some softening, but there was no going backwards. It just softened a little bit, but we've continued on that uptrend just because demand, people are tired of waiting. Demand is picked back up in the face of supply really staying somewhat the same. And all the supply is really coming from new homes, which is why we saw a drop in new home sales, but existing home sales are pretty consistently just going up and becoming more expensive. And a lot of people have been blaming it on the mortgage rate lock-in over the past year or whatnot. But to answer your question definitively, home prices are going to keep rising. I think even if we got a recession, the housing market will be inoculated from it in a way. We may see some softening, but we're not going backwards. Simple as that. And by the way, here's an interesting stat. You need to make in America now $110,000 per year to avoid paying 30% or more for like housing expenses. No, for your mortgage.
Yeah.
That's pretty insane, actually. So we're still at the most unaffordable point in housing history, but it doesn't seem to matter because inflation, in a way, is just making the rich richer. And so you still have a lot of flexibility in this economy, which is why we haven't seen weakening in the consumer. And as long as we don't see weakening in the consumer, the housing market, once again, should keep moving up. And then wages have been rising pretty respectively. You can argue now that they're rising faster than inflation. And so, I mean, we're sitting at a pretty good point right now. Just currently, if you want to take a snapshot of where we currently are, we look like a super healthy economy, and the Fed knows exactly what they're doing. That's what it looks like. And I'm not saying it's not like that or it is, it's just what it looks like. And also another interesting point, and I'll end it off here, is that, man, we're about to enter a time where we're doing QT and QE at the same time. Have you guys thought about that?
Yeah, it's also a time where it's like stock markets can be high, but bond yields can be high. And normally that's like inverse as well. It's kind of crazy.
Yeah. So the Federal Reserve has projected 3 rate cuts. So they're going to be cutting rates unless they don't cut rates, because sometimes just them saying is good enough for the markets, right? But we'll see. If they actually cut rates, they'll be cutting at the same time they're engaging in balance sheet runoff, which means they're doing balance sheet QT while doing interest rate QE. And so I heard somebody say it the other day. Throughout history, it's not normal for the Federal Reserve to press on the gas and the brakes at the same time. That's exactly the point we're going into right now. And so it's just interesting times, man. Interesting times.
No, that is pretty interesting. Isaac, what's your thoughts on 2024, man?
General thoughts. I think I concur with a lot of what JT said. Yeah, I think generally speaking, I think we have kind of a coin flip when it comes to whether there's going to be a recession or not. And this is what most like predictive models are kind of putting out. You have Statista, 51.84% chance of a recession. The National Association for Business Economics, they literally say 50% chance. A lot of different groups have been kind of predicting, like New York Fed, which was that they from the Statista, they're the ones that said it's like a 51.8. Everybody's kind of saying it's like a coin flip. I kind of concur with that. I think that if rates are being lowered to match inflation, that's a good reason why rates could be lowered without it having to be like a system break, which a lot of people would be like, oh, well, rates won't go lower unless the system breaks. Well, yeah, I think that JT did a good job pointing out why that's not always the case. You could lower rates without a recession occurring. I think that I could see a downturn though. So even if there's not a recession, I could see this be like a bearish market. Mostly because people in the market are pricing in much more rate cuts than we're probably going to see. You know, I think that the last like betting odds is like 5.5 rate cuts for 2024. So if we're going to only see like 3, I mean, that's going to be, that's going to need to get priced in eventually. So I think people are being a little too optimistic right now going into the year, and we could see a correction. Also, like high rates are pretty normal throughout American history. I believe the rates between 1971 and 2023 on average were 5.42%. So it's like some people mentally, I think, they think we're going to go back to like 0% rates like we've had forever. And I just don't think it's going to happen. I don't think it's been fully priced in mentally yet into people's minds that we're probably not going to see free money for the foreseeable future, and definitely not this next year. So I think with all of that, we could see a recession, maybe not see a recession, but I think no matter what, we'll probably see another downturn in the market. My prediction would be that crypto would probably follow equities. It would probably also drop too, just because it's a very risk-on asset. I don't know though. I'm kind of steering clear personally, just because I do think there will be another good opportunity to enter the market maybe the next few months here.
Agreed.